Welcome back, everyone, to another episode on Living Your Greatness. This is your host, MUMME, and the goal of my show is really simple: to learn from those who have mastered their craft of what they do. So today we have a new guest to the show, and his name is Bob Thompson. He's the Senior Portfolio Manager at Raymond James. So without further ado, Bob, welcome to the show.
Hey, great to be on, Ben. I've seen a lot of your previous shows, and I'm really excited about doing it today.
Bob, let's kind of get started here. Tell us about your origin story. Where did you spend your years growing up, and what inspired you to become a portfolio manager?
Hey, it's a really good question because I think in this business, it is all about people and past experiences because you're a product of your past experiences, right? And that helps to shape everybody. So interesting enough, I kind of I grew up in, I was born in California actually, but Canadian father, so I'm a dual citizen of both countries. But grew up, and when we grew up, my dad and I were kind of destitute. Didn't have a lot of capital, a lot of money, due to my dad's health problems and lots of concerns. But I remember in the soccer games, the kids would all go out afterwards and go to the McDonald's or whatever the case was. And I would always say, "It's okay, Daddy, we don't have to go." Because, we had TV dinners and that's what we lived on. And, even up into my high school years when one day the barber patted me on the head and said, "You don't have to pay for your haircut because I know you and your dad are having a tough time. And someday when you can pay for your haircut, then you can start paying. But until then, it's on me." And I remember I said to my dad, I said, Dad, I don't want to ever be in that position again where people give us something for free because we don't have anything." And he said, "I know, I'm sorry, son, and hopefully someday it'll change." So interesting enough, I was starting to go to university at the time, and I was in the medical area, right? So I was getting a degree in anatomy, physiology on the science side, and it still interests me to this day. But kind of halfway through university, I got a good job at a supermarket, and it union job paid me some good wages for an 18-year-old, and I started to sock my money away because I never wanted to be in the position again where we didn't have anything. So because of that, I started to read, and I started to read about investing, and I started to read about how money makes money, how compound growth works, how dividends work, right? And basically, it was out of necessity because I didn't want to be in a position where we didn't have anything. Then that started to get me very, very interested. Obviously, I got more interested in the markets than what my degree was in. So when I graduated, got into this field after. But you asked a great question. There's probably a little longer answer than you were expecting. But the reason that I got into this industry was kind of a backward reason. And now it's obviously my passion has been my passion for many years. But if I hadn't gone through that financial strife in my early years, I would have been a doctor now or something in the medical field, right? So I think adversity creates opportunity. It's a great thing sometimes.
It's always so interesting, to hear about people's origin stories. And something that I want to shift to, I know you're a big believer in spending time with quality individuals. And in 2006, you wrote a book called Stock Market Superstars, where you essentially spent time learning from Canada's top money managers to understand, what makes them a successful money manager. And so, Bob, how do Canada's top money managers make millions of dollars in the markets?
Right. The reason I came up with the idea for the book, it was, I had read a book in the US called Market Wizards. And, I'm the sort of person, and I think most people are, that learn from stories. You don't learn from a textbook, right? You learn from the practical aspects of the business. And I remember in university, some of my best professors were actually medical doctors who had their own practices. And they would come in and they'd tell us, "Oh, this is the reason, we had this issue today with somebody's back, and this is what went wrong, this is what went right." And I remember those stories, and I learned a lot from them. So I wanted to kind of share people's stories, what made them who they were and why. And I thought that would be, and make it timeless so that, 20 years later, you could still read the book and learn a lot, even though markets had changed a lot. And, one thing that I had learned is, people's actions and what they say are quite different. And you can't really tell a lot from what somebody says. In other words, if you have 10 portfolio managers lined up, they'll all say the same thing as far as how they analyze stocks and what they look for, et cetera. But 2 out of the 10 of them will be very, very good. The other 8 will kind of be mediocre, right? So what is the difference? What made those 2 different? It's not what they say or the quantitative part of it, it's the qualitative aspects of it. It's how they look at the world. And how they look at the world is a function of who they are and their upbringing, right? So that was a lot of what I did in the book, is to these people's history, what made them who they were, what adversity did they have, what sort of things did they go through in life, maybe that like I had gone through, which made them look at the world they did. So what I did is I had I started the book in 2006. It interestingly enough, it came out in 2008, because it takes a couple of years to put these books together. And it came out in October of 2008. Right, the markets were absolutely getting destroyed. People were ready to quit investing forever, and we all laughed. I remember, because we had a party in Toronto with all these managers, and 9 of the 12 of them showed up, and the press was there, the Globe and Mail, the Financial Post, et cetera, taking all these pictures. But we were all kind of laughing because it was very dreary, the markets at the time, right? We'd never seen a financial collapse like we were going through right at that exact instant. But we obviously got through it. So your question was, what makes these people different? Well, it was different for everybody. Some of them are growth investors, right? Some of them are value investors. Some of them were people that were top-down individuals completely, and they had all been successful. And I chose different managers that had different disciplines, because no discipline is better. The discipline that you use as a money manager is a function of who you are and how you think a lot of times. So again, some of them are growth managers, and what they would say is, I buy a stock that's trending well, fundamentals are getting better, the valuations don't matter, and then they would pound the table. Rohit Segal, who was in the book, had a 25-year track record of beating the TSX 23 years out of 25. And he said, never, ever, ever average down. He said, averaging down is for losers. You don't average down. The market isn't rewarding you for your thoughts. Don't buy more of it, right? So I thought, okay, that's interesting. That's more of a trader, right? That you hear people talk about, go with the trend, et cetera. Then I introduced Tim McIlvaine in the book. And Tim McIlvaine used to be the chief investment officer for Cundall Research. And Peter Cundall was one of the world's best value managers. So I asked Tim McIlvaine, I said, why do you hold your stocks for so long? And he said, because it takes them so long to go up after I buy them, right? Which I thought was funny. And he said, I usually buy them and they'll drop 20, 25% within a few months or a year after I buy them. And I buy more. And then I buy more, and then I buy more. And hopefully near the bottom, I have my full position, and things turn around for the stock, but that takes time. So here were 2 people that had been both really successful at investing, but had completely different philosophies, right, on the market. And I thought that was fascinating, and it kind of comes back to who they are and their personality types and all that. As they say, the growth managers all drive Ferraris, right? The value managers all drive minis, right? It's just their personality. So how there was 2 people in the book, but I think a lot of it was how they look at the world. Remember that not everybody can become wealthy in the market. The least amount of people make the most amount of money, right? That's just mathematically how it has to work. You can't have the most amount of people making the most amount of money. Mathematically, it doesn't work properly. So there's a very small percentage of people make the most amount of money. And why is that? Because they aren't like everybody else, right? Because they think about the world differently, right? One of the managers in the book was Frank Mersch. He was very successful from the Altamira days back in the 90s. And Frank had a degree in philosophy, right? And I think that's really important, because I really focused in on that. I don't think he had a CFA. He didn't have a finance background. He had a philosophy background. And I asked him, I said, do you think philosophy has helped you to be a better investor? And he said, most definitely it has. He said, it taught me how to be a nonlinear thinker. And he said, in other words, I think his thesis in university was he had to prove there was angels in the world. And he said, I could have chosen to prove that there was angels in the world or there wasn't angels in the world. It doesn't matter. He said, whichever way you do it, you got to think outside the box. So he said, philosophy, he said, taught him to look at the same information as everybody else looks at, but to derive a different conclusion. And again, as Soros has said, that's the only way you can be successful. Look at the same information as everybody else and then derive a conclusion that's non-consensus, because anything that's consensus is already factored into the market. So I think that's really important. And you can't put your finger on that when you're just interviewing somebody and talking to them, unless you really dig deep to see what made them successful. You know, Eric Sprott was in the book, right? And we can chat more about Eric later, but, you know, Eric said, I have a reasonable ability for looking at the same dots as everybody else looks at, but being able to connect the dots to come up with a conclusion. And he said, I don't quite understand why other people can't connect the dots the way I see it. But obviously that's a talent that he has. That's something that he's developed differently from everybody else.
Right. And I want to stay with you on Eric Sprott. He's a close friend of yours, you know, a very successful Canadian billionaire. But can you tell us like the story of how you two originally met and what investing lessons have you really learned from him, you know, in terms of investing in precious metals?
You know, I really do my due diligence on funds, on stocks, and on people. So I heard about this guy back in early 2000 that was a star manager in Canada. He started up a hedge fund in around that time frame, 2001, I think it was, or 2000, right at the end of that time frame. And I had heard from a lot of people that he was a great stock picker, right? Nothing to do with gold and silver at the time. He was just a great stock picker. So I did my due diligence, figured out who he was, why he was who he was, and we made some introductions back at that particular time. But originally, I think what's interesting, what caught my attention is a lot of people didn't realize that, Eric ran something called the Sprott managed accounts. So it wasn't a fund, but it was managed accounts that he ran for clients of his company. And from 1982 to 2007, Eric had managed to perform 25% a year over that time frame, which put him, it was 25 or 27% a year over 25 years, which is absolutely incredible. Nobody has ever put up numbers like that. And interesting enough, he didn't do it with buying gold and silver stocks, right? He did it just being a general money manager and investing in small to mid cap stocks. So he owned 10% of Taser at one point, right? Taser was a 50 bagger, I think, for him, right? Stocks like Hurricane Hydrocarbons, Centurion Energy, lots of energy companies. Some gold and precious metals companies, sure, but you didn't make a lot of money in those companies in the 80s, right? or in the early 90s. There were little spurts, but it wasn't a big general bull market for precious metals at the time. So I asked him, I said, what's the secret to your success at picking stocks? And he says, well, I like to buy a stock today that for $1 that I think will cash flow $1 a share in 3 years. And he said, if you buy a stock today at $1 that will cash flow $1 in 3 years, that's going to be a multi-bagger for you, right? But it takes a lot of stocks. We could talk a little bit more about how many stocks and how you buy them and how many actually make money for you, and the mathematics of all that. It's actually fascinating. So introduced myself to Eric. We started chatting in early 2000s. Did my due diligence for when the book came out, kind of kept that up. And I live in Vancouver, but went to Toronto a few times. Sat down with Eric, asked some pretty in-depth questions about him, his past, who he was, his family, when he met his wife, all these sorts of things, because it tells you about who makes somebody who they are. And then obviously, maintained a friendship over the years.
What were some lessons in terms of like the decision-making process of stock picking that you learned from him, especially behind like the mathematics, if you could dive a little further?
Yeah. So Eric once told me, he said, you got to be by yourself in a room. And he says, it takes confidence to do that. And he said, what I mean by that is that's when you accumulate large positions of small companies when nobody else wants them. And he said, because everybody else is partying in the other room. And he said, in early 2000s, that was technology, right? Everybody's partying in the technology room, buying Cisco and Nortel and all these companies. WorldCom, Enron, you know, all these sorts of things. And he says, and you got to be partying in the other room, accumulating positions of companies that nobody else wants. And he said, it's a very lonely place to be, and you need conviction to do that. You really need a lot of conviction, right? Because you look bad for a long period of time when you're doing that. But he said, when everybody in that room decides it's time to party in your room, it's an awful small door to get through. And it's a bloodbath to get through that door. And the volumes explode, and the prices explode on the stocks. But because of the macro factors that he saw happening in 2000, 2001, he got very, very interested in gold, right? And that became almost exclusively what he did at that particular time. And interestingly enough, most people don't know that from 2000 until now, gold has outperformed the S&P 500, right? 99.5% of people you talk to have no idea of that and wouldn't believe you. So his thesis was correct, and I think we're going to accelerate that as we go forward here. But yeah, the mathematics of how it works. Well, interestingly enough, I mean, Eric didn't really teach me this. This was just something that I've learned over the years, but it relates to how he's been so successful at stock picking for many, many years. So when you buy a stock, the maximum amount of money you can lose on that position is 100%, right? Unless you're leveraged. But if you're not leveraged, you just pay cash, you can lose 100% on a position. The maximum you can make on a stock is unlimited. 1,000%, 5,000%, 10,000% on a stock. So inherently, the market is skewed for you to do well over time, right? If you only need a few big winners, right? And I think you've talked about Pareto's principle. I've talked about Pareto's principle a lot, the 80-20 rule. 20% of your stocks will represent 80% of your return over time. So when I did my chapter on Eric, it was called Hitting Home Runs. That was the title of the chapter. And the reason for that is because, as we know in baseball, the people who hit the most amount of home runs are also the people that strike out the most, right? Babe Ruth, nobody talks about it, but he led the major leagues in his career in strikeouts. But he also got 714 home runs, right? So if you're swinging for the fence with every pitch, you're going to hit a lot of home runs, but you're going to strike out a lot. And Eric talked about that. He said, I buy 10 stocks that I think are going to be great. I won't buy a stock unless I think they're at least a 5 to 10 bagger. That's hitting the home run, right? Not a lot of singles he's shooting for. But he said, 2 or 3 of stocks will be fabulous winners, 3 or 4 will be mediocre, and 3 will go to 0, right? But the 3 to go to 0, you're only losing 100% on those. The 3 that go up a lot, you're making 1,000% or whatever the case is. So mathematically, it works in your favor, but you got to buy all 10 because you don't know which 2 are going to be the 2 or 3 that make all your money for you. So that's kind of the simple mathematics of it. But when you short, and as I mentioned, he had a hedge fund. You have to have a lot of conviction because the math is completely opposite, right? The maximum amount of money you can make on a short position is 100%, but you can lose 5,000% or 10,000% or whatever the case is, right? So you have to think things a little bit differently when you do that. But he saw this back in 2000, started up a hedge fund, went long gold stocks, went short technology stocks and bank stocks, because he said back in 2006 that you will be shocked at the global financial institutions that go to 0, and he named them right at the time: Morgan Stanley, Citicorp, et cetera, and they all did almost go to 0. They would have gone to 0 if they hadn't been all bailed out, right? So anyway, the hedge fund was up 150% over a couple of years, when the market was down 50, the NASDAQ was down 80, because of that positioning. But he saw it happening, but he started talking about it in 2006, right? A couple of years before. And I think that's important, is that you can hardly ever get the timing right? You might be a couple of years off. Howard Marks once said, the difference between being wrong and being early is sometimes indistinguishable, right? So I think that's what's important, and I'd like to talk about that a little bit more later on, maybe patience and how most people lack that.
I appreciate that answer, and also, that explanation of the way that Eric Sprott makes a lot of his decision making. And I know something that you incorporate in your decision making is the mining clock. So how could more investors use it to their advantage?
So yeah, I think a good way to segue into that is kind of talk about what we do in our business and why we got where we are here. I think something I've realized over a long period of time is that you need conviction to do well, but that same conviction will destroy you, right? So in our business, we deal with a limited number of families that are very high net worth that have complex needs, right? So a lot of what it takes to make the money that you have to become very, very wealthy are kind of the opposite attributes to what you have to do to keep it going forward, right? So we moved to Raymond James many years ago because there's a huge amount of depth about wealth protection, wealth enhancement, wealth transfer, right? Charitable giving. That's what people are. That's what people care about that have a lot of money. So I think, I just mentioned that because the mining clock helps people in the mining industry, and we don't deal just with mining executives, but we deal a lot with mining executives. It's a very, very cyclical industry, and as Rick Rule says, it only takes one cycle to become fabulously wealthy, right? So why isn't everybody in mining fabulously wealthy? Because they do the round trip, right? They make it all, and when things seem the best, they double down, they put more money in, and then they do the round trip and lose it all again and have to go through the whole cycle all over again. So what the mining clock helps to do is helps our clients, helps us to advise them in a very, very cyclical industry. When you have a lot of stock concentration, for example, in one company, it helps us to make the decision as to when maybe it's time to get out, and or not get out completely, but reduce positions, et cetera. And when you have to reduce your position is the point at which it seems like the stupidest decision to do that, right? Because everything is firing on all cylinders. You feel wonderful. You feel fantastic at the top of a bull market, right? I talked back to that psychology again. Norm LaMarche was in the book, and he was at Altamira for many years. Great resource manager. Still good friends with Norm to this day. And I said to Norm one time, back when we were in the depths of a bear market in energy and the metals, and I said, Norm, why don't you just retire? You're very, very wealthy. You don't need this. You don't need to be answering all these questions all the time. And he says, Bob, the problem is, he said, when you're at the top, right, and the market's doing extremely well, you're having too much fun. You don't want to retire. This is fantastic. And he says, when you're at the bottom, you don't want to retire because you don't want to leave at the bottom, right? You just feel too miserable. So he says, basically, you can never get out. You're sucked in all the time. So I thought that was a great psychology lesson that he brought up there. But so back to the mining clock. Let's just talk about that for a few minutes, because it is very, very important in a cyclical sector like mining. And I'll give you some dates as to when we were at different parts of the clock. So basically, you go from 1 to 12 in the clock, or 12 to 12, and as you go along, different things are happening in the market which tell you how far you are along in the cycle. And I think that's extremely good way to look at it. It's a way of reverse engineering where you are in the market, right? And taking the emotions out of it, seeing what the market is telling you, right? And that's why, over the years, Stanley Druckenmiller's always said the best economist he's ever known in his 50 years managing money is the market. The market tells you what's happening, right? And that's why central banks always get it wrong, because they don't look at what the market's telling them. They look at their economic numbers, which are always, basically completely wrong. So, what's the market telling us where we are in the cycle? So let's go back to 2013. Okay, that was pretty much as I say, the vomiting bottom of the market for gold and silver stocks. Started in April of 2013, when the market completely kind of puked out, and then it just got worse until 2015. So that stage, 1 o'clock, 2 o'clock, 3 o'clock, is when companies really have to get rid of their private jets, right? They have to downsize. They have to get rid of projects that they overpaid for at the top of the cycle. They have to write down those assets. They have to bring down their bloated costs of production, right? Because the underlying commodity price is dropping substantially. So when they do that, obviously they're cutting, they're selling their assets for 20 cents on the dollar just because they need that 20 cents, even though they paid $1 at the top of the market. And a lot of these companies will almost go bankrupt, right? When this happens, obviously everybody's extremely negative. Everybody's just trying to survive, you know, and a company, when confronted with falling off a cliff, just like a person, will do everything they can to hold on, right? Their fingernails will be ripping, they're clawing to hold on. The ones that can hold on make it through, and that's fine. But by doing that, they have smaller companies, they've brought down their costs, and they've sold off a lot of their assets. So that happened up until 2015. That was from kind of 1 o'clock to 4 o'clock is when that happens. So if you recall, Glencore almost went bankrupt, right? Teck Corp here in Canada, you know, kind of did the round trip and was barely hanging on, but they made it through. Then we get to 4 o'clock, and that's when basically the metals prices stabilize, whether it's copper, whether it's uranium, whether it's gold, whatever the case is, right? And you know, I went through this a few years ago, the mining clock with Ross Beatty. He hadn't heard of it necessarily, which a lot of people haven't. And Ross kind of admonished me. He said, well, mining clock sounds like a good idea, but you can't have one mining clock for all the metals because copper is different than gold and uranium and every other. And I said, that's true. You're absolutely right. So what we've actually done is modified the mining clock, and we have different colors for where the different metals are on the mining clock. But the precious metals tend to lead the way. They lead the way down. They lead the way. They lead the way back up. So at 4 o'clock, you basically get a bottoming in the prices. Most of the companies that should have gone bankrupt have gone bankrupt. They've sold off their assets for pennies on a dollar, but in doing all of that, they've brought down their costs too. So they brought down their costs approximately to the level that the underlying commodity is at. Okay, but it's a trailing indicator. They continue on even after the metals prices have bottomed. So then from 4 o'clock to 8 o'clock, that's when you get a stabilization in the prices. And you get companies starting to worry, maybe that when you get to 5 or 6 o'clock, when the prices start to rise, that they don't have anything in the pipeline anymore, right? You know, a company like Barrick a few years ago was producing 5 million ounces of gold a year with 35 million ounces of reserves. I mean, they don't have a company in 7 years unless they replenish the reserves, because it's a depleting asset. So then they start to think, well, we've got to replenish our reserves. We got to either go drill ourselves, find some new deposits, or buy somebody that that has a good deposit. So then you start to get the M&A around 6 o'clock, you know, that 5 to 7 range. And they start to buy companies for cash because they're cash flow positive now, because they brought down their cost to a point that they're making a profit, right? Their expenses are fairly low. So with the cash, they start to make some acquisitions. Then you get up to 7 o'clock when the metals prices are doing fairly well. Everybody's making money in the sector. Prices have moved up nicely. And then you get junior companies that start to do a lot of exploration. They can raise money. You get junior companies that IPO, and things are a little bit different today with the regulatory environment. So you aren't getting a lot of junior IPOs, but we're kind of in that stage. Then you start to get some big discoveries that are made. Then you start to get the big companies start to buy these discoveries, right? And you get up to 9 and 10 o'clock when, you know, people that work at these big companies, geologists, for example, they say, oh, you know, I'm sitting here rotting away at a big company. I could be working for a junior, getting all that stock and getting the options and doing a lot better for myself. So they start to leave the big companies, right? Because they're rewarded by going to the juniors. Then you get the big companies that say, we're gonna buy out another company in these mega mergers, but you can't spend $15 billion buying out somebody with cash. So they start to do it paper for paper takeover. So somebody's buying another an overvalued stock with their overvalued stock. So overvalued stock with overvalued stock. And when that starts to happen a lot after the market's had the huge run, that means that you're coming to the end of the cycle, right? That these stock for stock takeovers. Then you start to get governments come in and say, well, people are making way too much money in this sector. We're going to start to raise taxes. We're going to raise royalties, because governments are always a trailing indicator, right? Governments are always reactive. They're never proactive, right? So the governments react to mining companies, whether it's in an individual country. Canada is no different. Then they raise the taxes right when the market is peaking and crashing. And that obviously makes the crash a lot worse, because now these companies owe a lot more taxes in a crashing sort of environment. So that's kind of the whole cycle, and that takes years to go through, but we look for these certain things happening, and that tells us where we are in the cycle. And interesting, here it's not just, doesn't just work for the mining sector. I mean, it's basically a credit clock. Okay, so I had a 22-year-old student working for me back in 2017, and he was cautious, but he said, Bob, I know you like metals and this sort of thing, but you mean these marijuana stocks, these pot stocks, they're just gonna, I mean, you got to do it. They're going to change the law. They're going to make it legal. This is just going to be an explosive sector. We have to invest here. And I remember it was the late 2017, and I said, okay, let's apply that to the mining clock. I said, what just happened? And I forget the names of the companies, but some company that was worth $8 billion from nothing in 2 years bought out another company for $1 billion that had IPO'd like 3 months before, and now they were worth $1 billion. And they did a stock for stock buyout. And I said, look, this company's using their overvalued stock to buy somebody else's overvalued stock from 3 months before that was worth nothing, and now it's worth $1 billion. I said, I would argue to say that we're at 10 or 11 o'clock for this cycle. And he said, no, Bob, I mean, things are just wonderful. It's great. Well, from that point on, over the next 2 years, the best performing marijuana stock probably dropped 90%. And that was the best performing. And the rest of them went to zero. So that was the tech cycle back in 2000, whatever the case is. So I think, to have something that takes the emotions away, that you can just look at the market and say, what is the market telling me? What's happening in the market? Because that's where we are in the cycle. I think that's important. So I don't know, that's a long-winded answer, but okay.
I appreciate that explanation. I think it's important for many investors, to get a better understanding of the mining clock. And Bob, I'm curious to ask, I've heard you talk a lot before about the concept of sea change. I believe it's from Howard Marks. And so that being said, could you explain us about this concept and how you see this affecting the gold and silver over the next decade?
Yeah, I'm a big believer in the mark and reversion to the mean in the markets. And the more things get out of whack, the more the pendulum is going to swing the other way. And I think that's a lot of what sea change is, because happenings in the market create dislocations, right? And if you can look at these dislocations, again, it's really hard to get the timing right. But if you can look at these dislocations and say, what's going to happen when things revert back to the mean, I think that's what's really, really important. And, Howard Marks has talked about 3 sea changes in his life. I'm a big Ray Dalio believer, because he talks about history and how history doesn't repeat itself, but it rhymes, right? I've read a lot on Jim Rogers and We can talk about a couple of his books after, but I was able to interview Jim Rogers a few years ago, which was fantastic. I enjoyed that a lot from his home in Singapore. But Jim Rogers talks about, if you want to get a degree in, or sorry, if you want to do well in the markets, the first thing you should do is skip the degree in finance. And he says, get a degree in history, psychology, and philosophy. That'll make you a lot better investor. And I know I'm going off topic just here for relate to your question. Jim Rogers talked about how he taught at Columbia University. Always say to these kids at Columbia in the MBA program, how much does it cost to get your degree at Columbia, your master's degree? And they would all, somebody would raise their hand and say $100,000. And you'd say $100,000 for a 2-year degree. That's fantastic. He said, so I'm here to tell you that most of you will be better off to quit today, go start a business with your $100,000 and go bankrupt in 2 years. He said that will be a better use of your $100,000 than being here, because you will have learned a lot more about business. So he said, so if you're not going to do that, which I suggest you don't, let's learn some practical things about business, right? And that's what I'm here to teach you, which I thought was fascinating. So, and I think, that's why Howard Marks is so successful, because he's very practical. He's very good at, looking at the market from a different perspective. So what did we see, I think, in the markets? I mean, what we saw 20 years ago was that there was too much debt, there was too much money printing, there was fiscal irresponsibility, monetary irresponsibility, all kinds of things. So it's been delayed. Things have been delayed for years. And I think we're at the point where they can't be delayed anymore. Why were they delayed? Because, the government continued to just print money. They kept plugging holes, right? Again, when the Titanic is going down, you're going to try as much as you can to stop it from going down and plug the holes, right? And that's been a decade-long process. But we're getting to the point with 120 trillion of unfunded liabilities, $35 trillion of debt in the US, where your options for plugging the holes are a lot less than what they were before. But the problem is actually a lot greater than if it had actually been addressed many years ago. So that's the general thesis as to why I think we're going to be in a great bull market for precious metals going forward, because the options for fixing these problems have diminished. But I think what's interesting is, gold prices have continued to go up very, very well over time. And I think the market knows that, right? The market is the best indicator of what's going to happen in the future. As far as, a sea change, this has caused a lot of social, economic, and political issues, this debt that we've been acquiring over all these years. And Ray Dalio wrote a piece recently about the stages to a civil war of any country, and he said he's looked at 50 countries over history, and they all have the same stages, right? And it's all because of the debt, right? It's caused by the fact that people expect something that they can't get anymore because you can't continue to print money. And what that causes is it causes social divisions. It causes the right to become further right, the left to become further left, and nobody in the middle to actually moderate. And that's where we are right now in the world. So during these environments, you get these inflationary things that happen. You start to get people losing confidence in governments. You start to get people losing, on both sides, you start to get people losing confidence in currencies, and there's no way that the government can manage it anymore. So it doesn't mean that, the world's not going to survive anymore. We're all going to be here. Things will be fine. We'll still be building infrastructure and things like that. But what's going to happen is, commodities in general, and especially precious metals, start to have big runs. And I think what's important here is people tend to think that, gold goes up in price, or oil goes up in price, or copper goes up in price. That's not the main reason why the price of these metals goes up. It's not because of the demand or the supply or whatever. Remember, all of these metals are priced in US dollars, right? So instead of thinking of the US dollar as kind of the anchor, and the gold goes up or down in relation to the US dollar, let's think of gold as the anchor. And if the US dollar goes down, gold goes up in US dollars, right? So I think that's important to realize is a big function of all commodity prices, all commodity cycles when they happen. The price of commodities is going up because the value of the dollar is depreciating, right? And I think the world is realizing that, the US dollar is going to depreciate in value over time, right? Especially when they start reducing rates, right? They've kept rates very, very high now in relation to other countries because everybody else is a worse basket case than the US. But when that starts to turn over, then commodity prices start to rise. And I think what a lot of people don't realize is that, again, it's just reversion to the mean. These tend to be 16, 18-year cycles, right? The quantum fund run by Soros and Jim Rogers was up 4,000% during the 70s into the 80s. During that time frame, when the fund was up 4,000%, the S&P 500 was flat for 16 years. From 1966 to 1982, the S&P 500 was flat, and the quantum fund was up 4,000%. So whenever there's a bull market in something, there's a bear market in something else. Then, if you recall, from 1982 to 2000, commodities did terrible, really, for 18 years. But the stock market surged, peaking in 2000, and then crashing. And then the U.S. stock market from 2000 to 2012. A lot of people don't realize this. Everybody's all bullish on the S&P 500. People didn't realize from 2000 to 2012, the U.S. stock market was flat. It did nothing for 12 years. Who stuck with that? Nobody. Everybody wanted to be in Canada. Everybody wanted to be in commodity stocks, oil stocks, etc., which had this dramatic outperformance. Now, from 2012 to 2024, approximately 12 years again, 12 to, this cycle, the U.S. stock market has surged and done extremely well. And guess what? We're back to where we were in 99, 2000 with the U.S. stock market. All the things that are happening internally in the market, the concentration into individual stocks, etc. That's everything that happened back in 99 and 2000. And guess what? Everybody wants to be there. Everybody wants to be playing there. Nobody wants to be playing in commodities, which I dare to say we're at that point right now, that commodities and commodity type investments are going to be the best performing assets for the next 12 years or 14 years. And when everybody understands that we're in a bull market for those, you never know you're in a bull market until it's too late, right? When it's obvious you're in a bull market, you should be out. You should be doing something else, right? The time when you invest is when it's not obvious you're in a bull market. So it's obvious we're in a bull market in the S&P 500, so everybody wants to be there, right? What's interesting, though, is that, again, this sea change is happening. XME, which is an ETF in the US, a metals and minerals ETF, XME over the last 5 years is up 130% over the last 5 years. The S&P 500 is up around 90%. So already, for 5 years here, the metals have outperformed the S&P 500, and nobody knows it. Nobody even knows it, right? Because everybody's still rushing to get into the S&P 500. Well, when it's obvious and when everybody knows that metals are going to outperform forever and the U.S. stock market's a terrible place to be, guess what? Right? It's time to make the switch again. We're years and years and years away from that, but that will happen.
And so, Bob, what are some investing rules that you stand by?
Well, and it's different for everybody. My investing rules are going to be completely different from somebody else's investing rules. It doesn't mean somebody's right and somebody's wrong, but over time, I've learned patience. I've learned to have a lot of patience and learned that you're not going to be rewarded tomorrow, and that you could seem wrong for a period of time, and because you seem wrong doesn't mean you're wrong, just means that you are early. But I've also learned that being early is how you make the most amount of money, right? So because of that, I've become a really big contrarian, because I believe in reversion to the mean. I believe that when things get out of whack, that it's going to come back ferociously on the other side. And if you have that conviction and that you believe that's going to happen, then all you have to do is wait and be patient. Okay, and that's easy, to wait and be patient. If it becomes a when question, not an if question, right? So let's go back to, a big contrarian sort of approach that I did back in 2019, 2018. I was a huge believer that the uranium cycle was going to come back into play, right? Because the cost of production was way higher than the uranium price at that time. And I said, I think that this is going to be a great place to be sometime in the next 5 years. I don't know, right? It might happen next year. It might happen 5 years from now. But if the upside is 400 or 500%, it's worth the wait. And the way it works in the market is you usually have to wait 3 years when you're wrong, or it looks like you're wrong. And then the last 2 years, it makes all your money for you, right? It'd be nice to pick the bottom and know exactly when it was going to go up, but you don't. So, right now, as everybody's talking everybody's talking about uranium and that it's going to be a great place to be for the next few years, and it probably will be. Most of the stocks that were bought back in 2018, and they're already at 500%, 600%, right? So that's what I do. I'm a big, now, do you manage client money that way? You can't manage client money that way. You lose money for 3 or 4 years, but you can take a position, right? So we bought Cameco at 2% weight or something like that, 3% a few years ago, and the stock's up hundreds of percent. That's great, right? But there were other things that were doing well at the time also. So I think that's what's really important for me is you can't have that conviction unless you have been doing it for a long time, right? It's been 30 years for me now, and I see these things happening over and over and over again, and this reversion to the mean in the market. Buying when others are fearful and selling when others are exuberant, and that's my approach. So, what do I think now? I mean, a lot of the uranium stocks are up 600% from the bottom. That's great. There might be another double with them, right? Because if there's a double, that means they'll be up 12 times from the bottom, right? Which is fine. So I look for what's the next sectors that are going to be near the bottom. They're going to show those sort of returns going forward. And I think, the precious metal stocks, right? Probably going to do that, especially the juniors. Interesting enough, the biotech sector is in a similar situation. Biotech when it has a huge win, it's a really big win. And I should say, I'm just throwing lots of things around here. This is not financial advice, right? People shouldn't take the advice at all. Everybody has different scenarios, different situations, and things like that. And when we invest for clients, we always look at what the client's goals are and invest according to those goals, not what I think about the markets or what I think is going to be a great sector or whatever the case is. You have to invest according to your own goals. But I'm a big believer in being a contrarian. And if you do your due diligence, if you have conviction, then it's easy to be a contrarian, because now you just have to wait. And if it's this year, next year, the next year, it doesn't matter, right? The returns will come, the market will come to you, and I think that's important for me. So I look at a lot of these traders in the precious metal sector that say, oh, hold off because we're going to have a 5% correction and then buy at the bottom and then wait till it goes up and then buy and sell. And I don't, that's not me, right? I pay attention to the technicals. I pay attention to these people that are trading, because I don't sell. I just buy more at, hopefully near a short-term pullback. But I'm not trying to trade in and out like that. It's more of a longer term thing. Now, there's a big danger to, especially in the precious metal sector, to doing what I'm saying. And what the danger is it's such a volatile sector. You have to have conviction. You must have conviction, or else you can't survive, right? There's nothing as volatile as metal stocks. And if you're going to get knocked out with each time they have a 30% correction, you're not going to make any money. So you have to have conviction. Now that conviction works against you though, because if you buy a stock that is $1 and it goes to $2 and you have conviction and it goes back to $1.50 and you keep it and it goes to $2.50 and then it goes back to $1.50 and it goes to $3 and it goes back to you know $2 and you know the stairwell approach up. You know, when that thing gets to $5, you look and you go, okay, I've gone through a huge amount of volatility here, but I have conviction. This is the best thing. I'm going to hold it. That is dangerous, right? Because the conviction makes you lose sight of when it's time to get out, right? So you have to be able to make these decisions that, okay, most of the gain has happened. Things have changed. It's too much in my portfolio. Whatever the case is, I'm selling. Okay. And if I'm selling at 5 and it goes to 7 or 8, that's okay. I'm out, right? You've got to do that because that conviction that it takes to stay in is the same conviction that destroys you over time. So that's very important. And that goes back to the mining clock. Because the mining clock can help you with that decision-making process. And you know, if you've made tremendous amount of money, if you're a mining executive, it helps you create your legacy. It helps you, you know, keep your money for your family, helps you create the lifestyle that you want to have without giving it all back.
I think that's really great advice, Bob. What are the most influential books that you believe hold great value for investors?
I think you know, Market Wizards, the whole series was a great series. I enjoyed them because again, they were Q&A with these managers. They weren't all stock pickers. Some of them were options traders, whatever the case was. They all had different philosophies. A lot of them are traders, so they were more short term in their kind of thinking. But there was a Stock Market Wizards book too, which was more longer term stock market people, which I thought was fascinating. But you know, the psychology is what's the most important. So any books you can find out there on psychology and behavioral finance was fantastic. I mean, Kahneman was a great one on investing psychology, behavioral finance. There's a book called The Psychology of Money, which is relatively new, but I think that's fascinating because that again talks about the attributes that make somebody successful and what it takes to keep your money versus just making it, because keeping it is a lot harder to do a lot of times. And it's going through that transition. That's what we work with clients a lot on, is that psychology of going through that retirement kind of decision-making process, that everything you've done to make the money that you have is exactly what you have to do opposite to kind of keep it going forward. But we also have something called Thompson Learning Academy, which is made for kids and the next generation, which is super important because the biggest issue that really high net worth people have that have made a lot of money is that they're going to hand it off to the next generation, and the next generation is going to lose it all, right? And by nobody's fault. Just, you know, all this experience and the experience that I've had for 30 years, or Eric Sprott's had for 50 years, you make a lot of mistakes, right? It's always 2 steps forward and 1 step back, and you learn from your mistakes. And after 30 years, you've made a lot of mistakes that you've learned from, and you don't make them again. Well, when you pass on those assets to the next generation, they haven't had the ability to make all those mistakes and learn, right? So I made mistakes with small amounts of money, right? The next generation is going to make mistakes with a big amount of money, right? And that's why most people that win the lottery are done. They're bankrupt after a few years because they have all this pot of money given to them. They haven't had the ability to learn how to handle money all their lives, so they make big mistakes with the money. So, you know, and a lot of that comes down to the psychology and understanding risk and understanding reward and all of that. So that's very important. So there's you know 2 or 3 books. One of the best books I ever read, and I still love it to this day, is Investment Biker by Jim Rogers. It was done in 91, 92. And again, it doesn't matter when it was done. You learn a tremendous amount from what he talks about in that book. And then his next book was called The Venture Capitalist. And then his next book was called Street Smart. So all the Jim Rogers books. And why do I say these books in particular? Because they're very practical. They're easy to understand. you can relate. People can relate to them.
I appreciate that answer, Bob. And
Sure.
a question that I asked all of my guests is, what is your definition of greatness?
You know, my dad often said, I'm glad you asked that question because, as I said, we didn't have a lot of money. My dad didn't have a lot of money, but my dad told me, he said, people have the wrong definition of success. He said, people think of success as the car you drive and the house you have and what you can show off and that sort of thing. He said, success, the definition of success is how many people's lives you've changed in a positive way. And he says, it doesn't take money to do that. Now, if you have money, it can certainly help because you can help change people's lives in a positive way with your money. But he says it doesn't take money to do that. It takes time. It takes thinking about other people, giving people a compliment, enhancing people's lives and making them better. That doesn't take money to do that. So that if that was my definition of greatness, that would I think be a good definition. Changing how many people's lives you've changed in a positive way.
I think that's a really beautiful definition. And Bob, now that you have a good feel of my show and kind of what it's all about, who is a future guest, someone that you know personally that you love to see on this show?
I don't know if you'd ever do it, but somebody that I think is a fantastic person, also a great market person, is somebody named Eden Rahim, and he's in Toronto, and he's a biotech manager now. But depth of knowledge, his way of explaining it, his experiences has been pretty fantastic. Not a household name, but somebody that has a lot of great things to add.
I appreciate that name. And Bob, just before we go, two things. Where is the best place for my audience to connect with you? And are there any last words that you want to add to this conversation?
Sure. We've got a 2-page newsletter with lots of links called The Gold Digger that I do every month. And, you can get that at Thompson Investments at raymondjames.ca. That's an easy way to connect with us. Well, I think, the big part of it is the big thing that people overlook is the psychology of investing. By far, that's far more important than picking the right stocks, being in the right sector, whatever the case is. Just understanding that markets, there's nothing magical about markets. Markets are just people, right? People make up markets. So if you want to learn about markets, learn about people. And people haven't changed in hundreds of years or thousands of years. We're no different than people were in the 1600s. We might have more technology, but our brains are not different. I mean, that's a minuscule period of time. So when you learn about history, and I think that's super important, read your history. History doesn't repeat itself, but it rhymes. So the things that caused the South Sea bubble to happen, right? The things that caused tulip mania to happen 500 years ago are the same things that will happen today and will happen in the future.
I want to take this last little bit of time, to really thank you for being here. Thank you for sharing all the knowledge that you've learned over the years. Thanks again for making time for the show.
Yeah, that's fantastic. Great, Ben.